Welcome. As mentioned, inflation numbers for Canada in June will be released tomorrow morning at 8:30 a.m. Eastern Time. For more on what to expect, let's bring in Derek Holt. I misstated Derek's title before the break. He is Vice President and Head of Capital Markets Economics at Bank of Nova Scotia. Derek, the market is expecting 0.1% as a monthly tick up from May to June in the consumer price index basket. What are you expecting, and where will your attention be focused?
Sure thing. Well, that's a good way of framing it, because I'm not different in terms of the headline number, but it's not the headline number that really matters here. It's the Bank of Canada's preferred core measures of inflation that are much, much more uncertain and next to impossible to forecast. There are so many different parts of the CPI basket, and the sensitivity in the trimmed mean, weighted median CPI inflation figures that the Bank of Canada prefers to exactly what happens to the composition of that very, very deep basket is enormous. And so in many cases, we just don't have the pricing information in order to be able to assess what's going to happen tomorrow. And so trimmed mean and weighted median, so trimmed mean taking out the top and bottom 20% of the CPI basket, weighted median looking at the 50th percentile, right in the middle of the basket, ranked from highest to lowest contributors, are the gauges that will matter. And they were quite hot the prior month. They both averaged 4.1% month over month at a seasonally adjusted annualized pace. And that threw a bit of a wrench into the works in terms of the prior pattern of 4 consecutive soft months that we had over January to April. And that motivated the Bank of Canada to cut at the June meeting. If we get another hot print tomorrow in those measures, the trimmed mean, weighted median gauges, it complicates the outlook for the July meeting a bit. I still think there's a high bar to knocking Governor Macklem off of a further cut, but it could get interesting if it's another hot one.
Your view is that the Bank of Canada does cut the rate on July 24th, but you think a hot reading here, as you just told us, could make that a more difficult decision for the bank?
I think it could. I think it could suggest from a market standpoint that maybe it was the first 4 months of this year that were just the temporary soft patch and we're back to something more normal. I mean, remember, we had an abnormally mild and warm winter aided by El Nino, and that motivated a fair amount of discounting in categories like clothing, for example, and even airfare and some last-minute travel vacation packages. It just wasn't as bad a winter to motivate that kind of activity as much as a normal winter. And secondly, we had a number of unusual effects in terms of the composition of the basket, particularly in the quasi-regulated prices, as all of the CEOs of telecom companies and grocers were hauled before industry committees in Parliament and told to account for their pricing behavior. And they all cut their prices just before appearing at those committee meetings. And so maybe now we're back to more of a normal pattern in terms of those drivers. And so this is a big debating point in Canada.
The annual pace of inflation reported tomorrow is expected to come in at 2.8% in June. That would be down from 2.9% in May. That is obviously 80 basis points away from 2.0, which is the target. The bank said some time ago that it expects annual inflation to reach 2.0 mid next year, mid 2025. Do you think we are on a path for that target to be realized?
I'll put it this way. I think the Bank of Canada is confident enough that we are, but it still remains an open question. And so how I express that in terms of expectations for the Bank of Canada is to be setting a relatively high bar against Governor Macklem being knocked off a path of further rate cuts. I think he probably does cut later this month, independent of what happens to inflation tomorrow. It's just it gets a bit more complicated in terms of their narrative if we get another hot reading. And we'll go along the path of delivering a few rate cuts before we can assess its impact. And it's kind of the reverse analog to what Governor Carney did when he headed the central bank back in 2010. Opposite circumstances, very, very low interest rates on the lower bound towards zero, and with a lot of uncertainty after the global financial crisis. And he said, well, the peak on emergency conditions have ebbed, and so we can start to experiment and get off that lower bound with a series of hikes and evaluate what happens. Now, well, the peak uncertainty with respect to inflation and the peak rates of inflation, the biggest problems of the pandemic and supply chains may be behind us or ebbing. Supply chains are flaring again, but the pandemic seems to be behind us. So maybe we can start that experimentation phase. And you don't quit after one. And it's like opening a bag of chips. Who opens a bag of chips and just takes one? delivered 2 or 3 at a minimum, and then 25 to 100 points worth of easing in keeping with our forecast for this year. Next year is a bigger debate, in my opinion.
Interesting to hear you reference Mark Carney, a former Bank of Canada governor. You believe Macklem, when you take a look at Tiff Macklem, is essentially dovish. You believe he was dovish on the way up, i.e. somewhat reluctant to raise interest rates, and is dovish on the way down as well.
Absolutely. I think he is a dove at heart. And he was giving speeches on fully inclusive maximum employment during the pandemic in the early stages when inflation risk was flaring and it was becoming increasingly evident that we were developing a big problem. And after only a lousy 4 months worth of soft inflation data, after blowing it for 3 or 4 years on inflation management, it only took 4 months of soft core inflation readings to pull him off the sidelines and start to cut and sound really, really dovish. I mean, he sounded in very cavalier fashion when he said that we're not even close to the limit of undershooting the Federal Reserve. We're not basically concerned about the currency, not concerned about the currency. And that sounded like a governor who's determined to go on a straight line path. And he guided several rate cuts coming, that it's reasonable to expect this. He wouldn't have said that if he was talking about next year. He's talking about several rate cuts being a reasonable expectation this year. So his forward guidance is shaky at best. It's often very unreliable. He did the opposite of what he said he would do going into the June meeting when he said he wanted months of further data, but then turned around and cut weeks later. So we have to take that with a grain of salt. But I still think in his mind, he's dovish. He wants to deliver a series of rate cuts and then reassess at that point.
Derek,